Welcome to the Create More Value podcast, sponsored by Fortuna Advisors, the boutique shareholder value improvement advisory firm. Create More Value is a series of conversations with senior executives, board members, investors, and other experts that have overcome challenges to create exceptional value for their companies. There are many ways to drive value, so we cover a wide range of topics. I am the host, Greg Milano, founder and CEO of Fortuna Advisors, and I hope you enjoy the conversation as much as I did. I would like to welcome Dan Sansone. Thank you, Dan, for joining me on our Fortuna Advisors podcast to create more value.
Good morning, and thank you, Greg. It's a pleasure to be with you again.
Dan Sansone sits on the board of directors of AdvanSix Incorporated and Ingevity Corporation, both chemical and specialty materials companies. He sits on and previously chaired the audit committees of both companies. He previously chaired the compensation committee of AdvanSix and now sits on their nominating and governance committee. Dan joined Vulcan Materials Company in 1988 as corporate controller and served as chief financial officer from 1994 through 1997, and again from 2005 through 2014. From 1997 until 2005, he was president of one of Vulcan's major operating businesses. As I quoted in my book, Curing Corporate Short-Termism, Vulcan Materials has been an extremely strong performer with a cumulative total shareholder return, TSR, including dividends and share price appreciation, of 426% over the 20 years ending in 2017. This far exceeds the performance of the overall market, which delivered TSR of 294% over the same period. That result is downright outstanding for a company that basically crushes rocks and sells construction aggregates, asphalt, and ready-mix concrete. Earlier in his career, Dan spent 8 years at FMC Corporation, where he was first exposed to value-based management principles and practices. So Dan, let's get started. Tell us what was going on at FMC when you worked there over 35 years ago.
Well, Greg, I joined FMC in the late 1970s. And if you recall your economic history, it was a period of rapid inflation that evolved into a recession. Mm-hmm. So there was a lot of effort and emphasis in the company on trying to understand which of their many businesses were truly profitable and which were struggling. At the time I joined, FMC had 9 business segments. It was truly a conglomerate in the 1970s version of that word. Those 9 business segments were then organized in about 50 different operating divisions, widely disparate industries ranging from defense equipment, tanks, and guided missile systems to agricultural and industrial chemicals, heavy construction equipment, food processing machinery, and numerous other businesses. These were all differing industries, different industry structures, different competitive positions, and very different return and margin profiles, and also importantly, very different growth profiles. So the company, when I arrived, was firmly already committed to decision-making based on discounted cash flow and net present value and IRR. That methodology was well entrenched in the organization. But they were really struggling to understand which of these businesses were adding value and which really didn't have a good potential. Mm-hmm. So they had efforts going on both in the corporate finance group and also in the corporate development group, trying to really answer those questions. Both how should we measure the businesses and how should we make strategic and portfolio decisions and capital allocation decisions for each of these businesses. Mm-hmm. So during the time I was there, a number of really interesting things occurred. Concurrently, the corporate development team was investing a lot of effort in CFROI as a measure to help make strategic decisions. The company was already heavily focused on return on operating capital employed for the businesses, but because of the inflationary environment, FMC at the time was one of just a handful of companies who produced inflation-adjusted accounting statements for internal management decision-making. So we were real focused on real returns on investment, both from an accounting standpoint and a CFROI standpoint. And I was part of the team that implemented the real return on capital, the inflation adjusted statements. And kind of at the end of that project, the CFO and the corporate controller said, we want to add one other metric to the output of this effort. And it was what turned out to be a precursor to an EVA type metric. We called it net contribution. It was a very simple calculation. It was operating profit after tax minus a capital charge that was charged against the operating capital employed. We called it net contribution. So that was pretty innovative for its time. I left FMC's corporate finance group in the early 80s and got signed out to an operating business. And so I kind of became disconnected from the internal decision making. But I think the best way to illustrate what happened is today FMC Corporation is a public company headquartered in Philadelphia with a single business, that being agricultural chemicals. I couldn't even begin to tell you where all the other businesses ended up.
Mm-hmm. Yeah, that's pretty good. I've done a lot of research on conglomerate businesses, and it's really kind of interesting. The more numbers of primary SIC codes you have, a number of different segments, especially that you get into, the worse the performance is. People like to talk about a conglomerate discount, but it's not a discount because people don't like conglomerates. It's a discount because conglomerates don't perform that well.
I think that's right.
We've published some good research in the Journal of Applied Corporate Finance on that. Some businesses can have many different business units, but when they have nothing in common, it's kind of hard to really justify it. Although somehow private equity firms manage to do it. They just keep them all very separate.
Very differently. They really do.
They don't try to make them run like they're one business.
Yeah, they do. And the one thing I would add is there were perceptions within the company among line management about which businesses were really strong performers and ought to be invested in more heavily. And as we began to have this myriad of metrics, CFROI and inflation adjusted earnings and real return on capital employed and net contribution, it began to change the view. Things that everybody kind of perceived to be really star businesses really didn't fare well under that set of magnifying glasses at all, which created a lot of internal angst amongst the line managers.
Yeah, I would say the majority of companies, I've been consulting using value-based frameworks for over 30 years now. And the majority of companies that we do like a portfolio evaluation for have the same experience. There are things they thought were their best businesses that really aren't, and vice versa. And it's the majority of companies. It's not just an occasional finding. It's actually,
I think that's
and
right.
Even now, all these years later, it's still, maybe shocking that so many, don't see the light as clearly as they should. But that's the real value of this kind of a framework. Just one more point on that, follow up on that. You mentioned CFROI, or cash flow return on investment, a few times. That's, of course, the primary measure in the Holt framework now, which was founded by people that came from FMC.
And actually, just to go one step further, when I was exposed to it, it was actually Callard and Madden as a precursor when Holt took them under their umbrella.
We met when you were corporate controller at Vulcan Materials. You were instrumental in getting them going with value-based management and in steering them toward us at Stern Stewart. How did the value focus get going, and what obstacles did you face?
When I joined Vulcan, the company was already solidly committed to utilizing discounted cash flows and net present values and IRRs for making strategic decisions. They were struggling with some of the same issues that FMC was struggling with in terms of evaluating the strength and attractiveness of various businesses. And more specifically, at the time I joined Vulcan, we had two segments. A construction materials segment, which was probably 2/3 of the revenue, 2/3 to 3/4 of the revenue of the company, and an industrial chemicals business that produced chlor-alkali products. So very different industries, very different business cycles, very different competitive environments. So we were really struggling with the same questions. How do you evaluate where to allocate capital, and how do you evaluate which businesses are contributing to creation of shareholder value. So those questions were further complicated by a short-term incentive program that had 6 different metrics in it, all weighted together, that frankly made it difficult for an operating manager to understand just what's important and what isn't important.
Mm-hmm.
You had profit and cash flow versus budget. You had profit, cash flow, return on capital against a 6-year rolling average. So you had growth features in there, you had return features, and it was really hard for the operating managers. And numerous times the guys would make the right decisions and see their bonuses suffer, and vice versa. So the decision to retain Stern Stewart was based partly on our then CEO Herb Sklenar's familiarity with Joel Stern. He had met Joel years earlier. I think Joel was still at Chase when Herb and Joel established a relationship. And we ultimately retained Stern Stewart to tackle a number of questions. You, as you recall, headed up the team that helped us with the incentive comp and the EVA system design. And we were really trying to get better alignment with what we understood to be the preferred way to think about value creation, but how to really translate it into a working measure that the operating decision makers could utilize day in and day out. I should also mention that when I joined Vulcan, they were 2 or 3 years into having implemented inflation-adjusted accounting statements as well. So I think my prior experience at FMC probably contributed in some measure to my being hired. So that's how we got started.
So in my book, Curing Corporate Short-Termism, I wrote a little bit about this. I said I once had a one-on-one meeting with Herb Sklenar, who you just mentioned. He was your chairman and CEO at the time. And during the meeting, Herb expressed frustration that he regularly approved 15 to 20% return investments, and as a company, you kept earning 8 to 10%. He began by saying that because nobody can really accurately forecast the future, we should expect actual performance to deviate from projections. But as he went on to say, if the inability to perfectly forecast the future were the only problem, there will be just as many projects that exceed the forecast as those that fall short. But the reality, of course, as with most companies, was that most projects fell short of the projections. Before we dig into value-based management further, maybe tell us a little more about Herb.
Herb was an amazing individual. He hired me and mentored me and supported me over my career with the company, and so I'll always have great admiration for him. A fascinating guy from a personal standpoint. In his own words, he grew up on a small dirt farm in Nebraska. He literally started school in a one-room schoolhouse.
Wow.
Went to a state university in Omaha. Was a brilliant guy, voracious reader, basketball player who quit the basketball team his senior year in college because he needed more time to study, and that then sent him off to Harvard Business School. And then he worked in a number of different organizations, both public and private. Had great experience. He joined Vulcan first as a CFO and then became CEO. He had friends and acquaintances throughout the business community in a lot of different industries, and was friends with a fellow Nebraska native named Warren Buffett as well. And so he was quite a leader, and he drove this whole value-based process, which I think is important from a process point of view in terms of implementation, because we didn't have to kind of buck a CEO who was highly skeptical of what we were doing. To the contrary, he was very, very enthusiastic about trying to get a better way to measure the businesses and provide better alignment with the incentive systems. So it made the project a lot easier to execute than it's been, I think, in other companies, at least based on some of the war stories I've heard. But a great guy, truly a great guy.
I agree with that completely. Yeah. Yeah, I remember him being very thoughtful. We would propose various options to how to deal with something, that we were trying to deal with. And the questions he would ask would be very, thoughtful. The way he would, try to understand all the pros and cons and then, come down firmly on a decision was just very admirable. You work with so many executives that are sort of wishy-washy in their thinking, and he was just so clear. It was really a pleasure. So thanks for mentioning that. I thought I enjoyed my time working with him, and so I appreciate that those comments.
Well, Greg, in the quote from your book that you mentioned, I'm not sure we actually solved the problem, but we probably did more than most companies in understanding the problem. One of the things that Herb had implemented when he was the chief financial officer was a rigorous post-audit of all major capital projects, be they M&A, be they greenfield sites, be they major equipment upgrades or product extensions. And that's where he really got his arms around that data that he referenced. Mm-hmm. We saw that we were persistently falling short of the projected results. In many cases, still earning returns that were more than acceptable, but that consistent shortfall was evident. And one of the solutions that Herb put in place was to essentially increase the hurdle rates. Mm-hmm. And we actually quantified the amount of return gap between predicted and actual that we are consistently seeing. Mm-hmm. And so our project return targets, were built off of estimated cost of capital. And then on top of that, this kind of shortfall factor, he called it. We had mixed results with that, to be candid. I think in terms of behavior, it just spawned more of the same kind of results, because if you had a really good project, to get it over the hill, you had to have an extra 200 basis points, 300, whatever the number was of return. Mm-hmm. And it probably caused operating management to err on the side of, aggressive in their projections, even for good projects, just to avoid the falling below that shortfall effect. Yeah. And we struggled with that, but over time that got removed from the hurdle rate construction. Mm-hmm. But that was an early signal in Herb's mind that we had to do something different in terms of measurement and incentive and project evaluation. Yep. So it was probably one of the early seeds that led to the EVA project. Mm-hmm. Mm-hmm.
Well, the way you describe that reminds me of something I just want to mention quickly. With a lot of companies I've worked with over the years that do lookbacks, they look back to see if it met its original projections, and which is fine. But there's a distinction I like to make. Let me construct a simple example. Let's say our hurdle rate is 10%, our cost of capital is 10%. And we approve the project that's supposed to earn 25%, and then it only earns 20. In many companies, you get beaten up because you missed your projections by 5%. But I always say to people, you should be praising them because they created a ton of value. They didn't create as much value as they said they would, but they created a ton of value. And it's that criticism for falling short that often stifles investment, because people say, well, I'm not going to invest anymore because I just get beaten up when I do it. And so I think the nature of the dialogue in the operating and investment look-back reviews needs to, as a primary point, recognize, did we create value or did we not? And then secondarily, try to figure out, well, why didn't we meet our forecast? Could we have forecasted better? Do we have something about our processes leading to bias or what have you? But I just wanted to throw that small point thing.
I think that's a great point. And the post-audit process did help us in a number of ways. particularly in our construction materials business, because those divisions had very, very similar footprints and operating assets. And we learned a lot about how better to forecast some of the costs that go into projects.
Mm-hmm.
Where did the miss come from?
Right.
And so it did allow us to improve some of our internal processes. So it was there was a lot more value to the process than just bayoneting the dead. One of our directors once said.
That's a good term. I like that. No, that's true. I think learning from the lookbacks in order to do better forecasting and make better decisions is probably one of the biggest benefits. I agree with that. That's good. So just moving on a little bit. So you wound up implementing a simpler version of EVA than sort of actual, sort of Stern Stewart formal EVA. And then the measure was changed again after you retired. Can you tell us a little bit about the measures that we used at Vulcan?
We implemented the EVA system within Vulcan. We brought it into all aspects of our financial reporting. We built it into our financial planning models. We had our division presidents provide commentary on it in their periodic letters to Herb. We in our DCF models, we calculated net present value of economic profit right next to net present value of cash flow. And if those numbers were materially different, that was the basis for digging in and seeing, is there an anomaly that we need to understand better or not? Mm-hmm. So we went pretty deep into it, and we got what you would probably saw many times is a predictable range of reactions to all of it from our line managers, from, hey, this is great, I really understand this makes sense, to you guys are ruining the company, and everything in between.
Yeah. Change is hard.
Yeah. Change is hard. The incentive system, we probably adopted more of your recommendations on the incentive system than we did on the definition of EVA or EP itself. We got rid of the 6 metric short-term incentive system completely. We had a single metric, that being economic profit. A huge change for us was the setting of the target. When we had 6 different variables in the incentive plan, you understood how the target was set for each one of them. It was mechanistic. A comparison to budget or a comparison to a trailing, average. But in the EVA system, we used essentially a moving average is what I would call it. So it was very adaptive, and both of our businesses were cyclical. And if you were in the up phase of a cycle, that target was chasing you up that hill. And conversely, when you turned into the down phase of a cycle, that target ratcheted down pretty quickly. And it took all the argument and negotiation and budget bias completely out of the target setting. And that frankly worked pretty well. In fact, I would say it worked very well.
That's good to hear.
The other part of the recommended incentive system that we adopted was bonus banks. And you could probably explain that in fewer sentences than I can. But essentially, we paid out only a portion of each year's declared award, with a portion going into a bank, and that got paid out over time as well. A portion of it got included in that payout. That was probably the hardest part of the system to explain to the plan participants. And I think that survived 4 or 5 years before our chemicals business went into a dramatic cyclical downturn. And, that business, in a good year, and I'm working from memory here, so I'm going to make numbers up. But, that business in a good year could make $150 million. In a bad year, lose $30 or $40 million. And it could go, that much gap can happen in a year or two. So what caused us to revisit the bonus banking system was a severe cyclical downturn in the chemicals business. The downturn was so severe that the plan participants no longer had any assets in the bank, but they had liabilities. And they were going to have to rely on a very dramatic recovery just to break even and start earning again. And we had some real concerns with the leadership in our chemicals business. And while we tried to model those kinds of scenarios before adoption, we just didn't get anything as severe as what actually happened. And so, that's when we dropped the bonus banks. I forget how we did it mechanically, but we eliminated the bonus banks and began just paying out the annual declaration. But I think the whole plan had some real important benefits to the company. It simplified the incentive system so people understood what they were expected to deliver. It was EP, economic profit. That's going to drive what we do. One of the little anecdotes that I remember that was I think a really interesting and positive effect is a couple of our divisional CFOs who really both understood the new incentive program and the decision-making implications of economic profit, created a simplified decision model for what I would call routine kind of division level capital projects. Is it time to replace a front end loader for $1.5 million or not? Or we've got 3 of them, that's a replacement project. You're going to replace it eventually, but is now the right time to replace it or not? And these 2 guys got together and constructed a real simple Excel model that allowed them to kind of put some variables in and let those day-to-day decisions be dictated by economic profit rather than just, hey, it's 8 years old or 12 years old, or it's about time to do it.
And you talked a little bit about some of what people were doing to try to make better decisions down in the organization after you got rolling with this. What other managerial behaviors can you share with the audience? What other things came out of this in terms of people's behavior?
I think because of the design of the plan and in the inclusion of one feature we haven't talked about, but I want to mention it briefly because I think it was important. I think we saw more managers willing to commit long-term capital for strong projects more willingly than they were under the old system. And the one other feature we built into our plan designs was a pro forma adjustment to the targets for acquisitions. We had the mechanistic target setting mechanism that worked fine for a steady state business environment. But if you were, buying a business that layered in a sizable amount of fresh capital, you were almost guaranteed that you were going to adversely affect the EVA or the economic profit in the first few years before that project began to take off and generate returns. So what we chose to do was for a division or a business that made an acquisition, we would adjust the targets for the first, I think it was 3 years of its life to take effect of the actual projections that were embedded in the justification model. So, if the model said in years 1, 2, and 3 they were going to generate, $2 million, then $3 million, and then $4 million of economic profit, we worked those numbers through the target setting mechanism so that if they delivered those numbers, they were incentive plan neutral.
Mm-hmm.
If they exceeded those numbers, it was incentive accretive, and obviously if they fell short, it was dilutive.
Mm-hmm.
And then the way the moving average target setting mechanism worked, by year 3 or 4, those numbers the actual numbers were already embedded in the targets.
Mm-hmm.
And so the fact you might be running at a considerably higher or even lower level of economic profit due to the anomalies of EVA calculation,
Mm-hmm.
it was factored into their targets. And so it made it, I think, easier to demonstrate to the line managers that go ahead and make this investment. If it's big enough to have a short-term adverse effect on the economic profit calculation, we'll adjust it, and we'll adjust it at the front end.
I especially like that there's a long-term accountability, right? Eventually, you've got to cover the cost of capital, or you're going to be, or some of the value you destroy is going to be your own.
Yes.
So that's really good.
And while I've been retired for a while now, I still read the annual reports and the proxy statements, and the company is still using a form of economic profit that sounds more similar to what Fortuna is advocating. It starts with EBITDA and it pulls a capital charge off. So they're still using it. I can't speak to how they're setting their targets. I'm just been away from it too long. Yeah. But the fact that it's essentially still there 30 years later, I think is a strong endorsement.
Yeah, I agree. And I appreciate you saying that, because I think one of the problems people have, totally aside from everything we've discussed, is they change their incentive plan every few years. And so people don't know what the deal is going to be. And I think when you put something in that with maybe just a few changes over time is endured like this, I think that gives people just a lot more confidence. We've been speaking with Dan Sansone. Thank you, Dan, for joining us for this very important conversation.
Well, thanks, Greg. It's always a pleasure to visit with you.
You have been listening to Create More Value, sponsored by Fortuna Advisors, and I am your host, Greg Milano, founder and CEO of Fortuna Advisors. I hope you have enjoyed this episode. Fortuna Advisors helps companies with strategy, capital deployment, business management, corporate culture, and incentive compensation, all aimed at driving top quartile total shareholder return and the equivalent for private companies. To learn more, contact us at info@fortuna-advisors.com.